In this video, we are going to discuss about how the US interest rates held after inflation fell to less than half UK's rate. So before we start, make sure to subscribe to our channel for more updates. After 10 years in a row of increases, the Federal Reserve, which is the central bank of the United States, decided to keep interest rates unchanged. The decision was made one day after official numbers indicated that inflation in the United States was 4%, which is less than half of the current level of inflation in the United Kingdom, which is 8.7%. According to the most recent information released by the Bureau of Labor Statistics, consumer costs went up by 4% in May, marking the slowest rate of increase in more than 2 years. As a result of the announcement made by the Fed, the interest rates in the United States will remain between 5% and 5.25%, which is a high that has not been seen since 2007. The Federal Reserve had been gradually raising interest rates in an effort to slow economic activity and bring price increases closer to the 2% target set by the regulator. In contrast, the rate of inflation in the United Kingdom in April was 8.7%. The gradual decline from double-digit inflation, combined with a labor market that features low unemployment and rising earnings, has prompted the market to anticipate that the Bank of England will raise its interest rate to 5.75%. This assumption is driven by the fact that inflation has been slowly declining from double-digit levels. In May, the Bank of England increased its base rate by 0.25 percentage points, bringing it to a total of 4.5%. As a result of this anticipated increase, financial institutions such as banks and building societies have raised their mortgage rates and removed certain mortgage products from the market in order to better prepare for the higher rates. The Office of National Statistics, ONS, is going to make some fresh data regarding inflation in the UK available on the Wednesday after next. In contrast to the United Kingdom, where the interest rate is expressed as a single percentage, it is expressed as a range in the United States. This is due to the fact that the Federal Reserve is not allowed to set a specific figure. The numbers represent a target rate that has been established to direct lenders. The Federal Reserve has reiterated that the banking system in the United States is sound and resilient. It is likely that more stringent loan restrictions for people and businesses will have a negative impact on economic activity, hiring, and inflation. The magnitude of these consequences is still unknown, the report stated further. The possibility of further increases was not dismissed. In determining the extent of additional policy firming that may be appropriate to return inflation to 2% over time, the rate-setting Federal Open Market Committee will take into account the cumulative tightening of monetary policy, the lags with which monetary policy affects economic activity and inflation, and economic and financial developments. The committee said, inflation should return to 2% over time. The committee added, inflation should return to 2% over time. In reaction to growing inflation, major central banks around the world are tightening monetary policy. This rise in inflation was initially brought on by higher pricing for goods and energy, in addition to bottlenecks in global supply chains. The announcement that the Monetary Policy Committee, MPC, of the Bank of England had increased interest rates for the 12th meeting in a row was made on the 11th of May, 2023. The new rate, which is 4.5%, represents an increase of 0.25 percentage points. The motion was approved by the MPC by a vote of 7-2. On June 22nd, the minutes from the upcoming meeting of the MPC will be made public. The Monetary Policy Committee, MPC, is raising interest rates as a response to growing inflation, which reached 10.1% in March, which is far more than the MPC's target of 2%. The MPC continues to anticipate that the inflation rate will fall sharply from April to approximately 5% by the end of 2023 in the predictions that were published accompanying the interest rate decision. Nonetheless, this is an increase from its previous forecast given in February, which was 4%. Since December 2021, the UK's interest rates have been steadily climbing. Beginning in early May, the Monetary Policy Committee, MPC, began bringing down the amount of its asset purchase program, also known as quantitative easing, QE, from its previous peak value of 800 £895 billion to £814 billion. It is accomplishing this goal through two distinct strategies. First, it is allowing some of the government bonds it holds to mature. And second, it is actively selling some of the bonds it retains onto the market. The Bank of England engages in quantitative easing by electronically producing new money as central bank reserves, which is subsequently used to acquire various financial assets, the majority of which are government bonds. In response to the findings of COVID-19, the bank implemented new policies in March of 2020. The interest rate was lowered to 0.1%, which is the lowest it has ever been in the history of the country. They continue to be at this level until the month of December in 2021. The MPC also increased the amount of money it would spend on its quantitative easing QE program by £450 billion in 2020 and 2021, bringing the total value of the assets it controlled to a record high of £895 billion. At the Fed's policy meeting that ended on June 14, 2023, interest rates for the United States Federal Reserve were left unaltered at a range that currently sits between 5% and 5.25%. The Federal Reserve stated that although it will skip hiking interest rates for the first time in more than a year, additional rate hikes were likely to occur later in 2023. The rate of inflation has decreased from recent highs, which contributed to the pausing of the cycle of rate rises that began in March 2022. Despite this, the rate of inflation is still significantly above its target of 2%. The amount of assets that the Federal Reserve is holding as part of its quantitative easing program is decreasing by $95 billion every month. By 15 March 2020, as a direct response to the COVID-19 epidemic, the Federal Reserve had decreased interest rates to within 1% of 0%, down from 1.5% to 1.75% prior to the pandemic. The Federal Reserve made a variety of announcements on March 23, 2020, all of which were intended to lend support to the economy. This includes purchasing debt from the government and corporations, as well as other securities, such as those backed by mortgages and other assets, to add to their holdings. In March of 2022, the Federal Reserve started increasing interest rates once more. The European Central Bank increased its key interest rates by 0.25 percentage points at a meeting that took place on June 15, 2023. Because of this, the rate on deposits increased to 3.5%. Since it first started increasing interest rates in July 2022, the ECB has increased them by a total of 4 percentage points. Despite expectations that it will fall, the inflation rate in the Eurozone is still significantly higher than the goal rate of 2%. The European Central Bank, ECB, has begun the process of winding down its quantitative easing programs as of March 2023. To do this, it will forego the reinvestment of €15 billion, a month worth of maturing assets that it owns in one of its two primary QE programs. The European Central Bank, ECB, initiated its pandemic response on March 12, 2020, and it was greatly expanded on March 18, March, and June 4. In addition, the European Central Bank, ECB, has made inexpensive loans available to banks in an effort to encourage the banks to lend money to firms. The European Central Bank, ECB, made an announcement regarding the establishment of a brand new bond purchase program known as the Transmission Protection Instrument, TPI, in July of 2022. If unwarranted, disorderly market dynamics are the cause of growing borrowing costs for individual countries' governments, the TPI is intended to be utilized to bring these prices back down, if and when this becomes necessary. Share your opinions with us in the comments below. And if you enjoyed watching this video, then give this video a big thumbs up and subscribe to our channel.